We talked about the most risky asset class. Ravi, so I would ask you to jump in, and we switch the pendulum. We talk about the most conservative asset class now, the old, boring deposits. Sounds very preachy, parental advice kind of a thing, but I remember in my childhood, my mother and my father would boast about that when you turn 18, we have done this recurring deposit for you, and you would get this much of amount. And parents, relatives, grandparents were really proud of this habit, that if you're doing FD, you're being really, really responsible. I think the narrative has changed now. I mean, FDs, it might happen that, if you want to create wealth, defeat inflation, FDs are not the best way. There are other asset classes, but I think, and we are partially responsible for it. I think the narrative has changed, where if you invest in FD, it's being told that you are not financially prudent, you're not disciplined, you're not taking care of your finances. So I think, what is your opinion on this? I think we are dealing with extremes here, and I think sometimes we influencers also, in order to be highlighted, and I'm being brutally honest here, in order to stand out of the crowd, we want to change the narrative. So if everyone says FDs are cool, we come on camera and say, see, this is the Excel sheet, these are the reasons why FD is not cool, and our video goes viral. So do you think this change in narrative is justified, and do you think FDs are being irrationally marginalized?
So I think it is fair to say that having your complete portfolio in FDs definitely is not a good hedge against inflation. I mean, at the end of the day, inflation is definitely greater than the interest you get from FDs. That said, like as our parents, and I think to be honest, this comes from personal experience, like having burnt hands as a day trader, like investing in risky
You
options,
need to
risky.
watch my videos, Ravish. You need to watch my videos.
No, I think I agree. I think let me just complete. So I think
Sure.
where millennials like me, initially go wrong, um, is when we sort of absorb advice from the internet, and I would say absorb this incomplete information from the internet, from platforms like yours as well, and then try to have their own theories and try to make their own incomplete understanding of the market and act on it. I think investing from a millennial perspective should be very simple. Like our parents, I know there is definite. I believe like there is definitely power, and there is definitely like logic in the power of compounding, and safe assets where you can continuously invest, like SIPs or FDs, or even gold. And to be honest, even though they don't sort of give you as much return, and may not be as best inflation hedges, they're definitely, I would say, in longer term, when you're compounding them, they're definitely a safe asset class that gives you compounded returns over time. So in that regard, I think the fundamentals of the investing don't change, even though the market dynamics for, or the availability of investment options has changed for millennials. So I think in that regard, FDs should form a certain portion of your portfolio that is sort of risk free. Also, I think beyond FDs, definitely there are other safe asset classes. So for example, I definitely believe over the last couple of years I've started investing in ETFs, exchange traded funds. They are I feel they're a little superior than even mutual funds, because they carry lower fees, etc., and they track the index. There's one more stat that I came across recently, that top 20 companies of in India account for 70% of the entire profit pool. So the and Vanguard also sort of I would say scaled up index investing in US. And if you see over a longish period of time, index investing and ETFs generally give a very safe and a very inflation hedged return over longer term. So I think the investing in and diversifying across these safe and, I would say, mindless asset classes, where you can just invest, you let your money compound and let it be risk free, basically, is the way to go. So I think FDs definitely does form somewhere in that portfolio, because most of them are sovereign backed. So they are even in terms of like turmoil, or when a country goes down, they're still like relatively safer compared to stocks, but I think they should form some portion of your portfolio.
I'm glad you said that, Ravish. I'm glad I kind of see this narrative where, everyone who invests in FD, even certain part of it, are considered, you're investing in FDs because you don't know other asset classes. So I'm glad you said that they still form an integral part of overall asset allocation strategy. And, you brought the point of sovereign backed, and which is the key here, that, you don't invest in FDs looking at higher yield, because in fixed yield instruments, higher the risk, higher the returns. So sometimes, we are trapped with cooperative banks, smaller regional banks in lure of higher yield, which is not the right way to invest in FDs. There has to be a balance, safety first, because if you're anyways going for risk, there are other asset classes available. FD is safety first, returns second. So I'm glad you said that they are part of a balanced portfolio. Adil, I want you to jump in. Let's talk about the next most boring investment instrument available. Passive funds, index funds, passive ETFs. Again, the same perception. And I'll say, even I have turned around my opinion. 4 years ago, I was not a fan of passive funds. I believed that, in India, there still penetration is low. So fund managers actually have this scope to find out inefficiency, mispricing, and generate alpha and defeat the market. But I think since SEBI reclassification, specifically with large caps and mid caps, where only top 100 companies by market cap classify as large caps, and a large cap fund up to 80% of its assets, it has to invest there. I think the through active funds, the ability to generate alpha in mid cap category and large cap category, in my opinion, has reduced drastically, which makes ETFs and index funds, passive funds, more relevant. What's your stand on index funds?
Yeah, so Pranjal, at Bank Bazaar, we are very fond of and highly recommend index funds. So I'm going to go with what Ravish has said, that these are funds which track the Sensex or the NSE. And we have an expert like Chanchal in this panel. I think Aditya Birla has some good index traded funds. Now let's look at the data, right? And I'll share a couple of data points, and the user can decide for themselves. So the first thing is, if you look at a developed or sophisticated market like America, the passive funds are 16% of the overall market and are actually larger than managed funds, which are about 14% of the market. And obviously, this can change over time, but clearly, index traded funds are doing well. Now, the automatic counter question we get, right, is, okay, what has been the 5-year return, or what has been the 3-year return on these index funds? And then again, right, the challenge we face, right, Pranjal, as a person who's trying to demystify and explain finance, is the 5-year, 3-year return is a rolling number. So it can change every quarter depending on when we speak. But usually, if we look today at a 5-year return, we're talking about something north of 12%. Now, the advantage of the index fund is the same advantage that equity mutual funds have. If you hold it for a year, the unit goes under long-term capital gains. So instead of paying 30% tax on an FD, you're now effectively paying 10%, depending on certain circumstances, if you're holding over a year. So I think if I, on my savings or the savings I'm building for my daughter, if I can generate over 12% and I can pay 10% tax on it, I would be really happy over the next 10 years. So yes, I would highly recommend index funds.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.